Hi, everyone. Thanks for having me. My name is Lennart Ante. I'm from Hamburg, Germany, where it's in the late afternoon right now. So happy afternoon, everyone. I see Daniel yawning. I guess it's a little earlier here. Um, so I'm going to talk about a working paper of mine that is called Liquidity Shocks, Token Returns, and Market Capitalization in Decentralized Finance Markets. Please don't be too surprised if I potentially start sweating or so, because I had quite a bad virus a couple of days ago. So that's not excitement or so. So yeah, glad to be here. Maybe one or two words on me. I'm the CEO of Blockchain Research Lab. That's a nonprofit research institution in Germany where we research all topics regarding blockchain, so not necessarily only finance topics, and we hand out scholarships to master on the master or also on the PhD level, and we're always looking for collaboration and for interesting partnerships. So if there's something interesting coming up, feel free to contact me. So coming to the introduction, all information on public blockchains is transparently accessible in real time. And I mean, I had a quick look at what the past seminars were talking about, and my feeling is that everyone here knows what blockchain is and what DeFi is, and there's no real necessity to explain Uniswap or something like that. But so I'm gonna simply dig in. So on public blockchains, we can always see how many new crypto assets are issued, be it stablecoins, be it tokens, what are they being used for? After that, are they transferred somewhere? And in DeFi, we can simply see when or how many crypto tokens sold on decentralized exchanges and to whom, or are specific tokens being lent out, or is leverage being used on them, et cetera, et cetera. So we pretty much have a transparent financial system. And as it's stated here, blockchain-based markets are simply much more transparent compared to other financial markets, such as stocks. And this is very interesting from a research perspective, because it provides us with a new means of data and new means of analysis, because now we can see if more transparent markets may actually be beneficial to the existing markets, because who says that the current structure of stock trading is actually the perfect one. So in decentralized finance, we have decentralized exchanges, so-called DEXs, and they are transparent markets where order book-like liquidity is managed via smart contracts, and users can actually trade directly out of their wallets. The term order book-like liquidity may be a little critical, because it's not necessarily always order books, but liquidity pools, etc. But essentially, all liquidity is on chain, and everyone can always see how much liquidity is there. So what was the motivation for my study? Maybe reading here first. So on January 17 in 2022, tokens worth 11 million of the project Olympus DAO OM were sold on SushiSwap in one single transaction. And at that time, OM actually had a market capitalization of $1.3 billion. And as a result of selling $11 million worth of tokens, the market capitalization of OM dropped to 900 million over a very, very short period of time. And this was very much discussed on Twitter, and everyone was talking about it because, hey, 11 million is pushing the price of the crypto asset by $400 million. What is going on here? There seems to be some sort of inefficiency. And yeah, I was also picking it up on Twitter and found it fascinating. And that's actually why I started working on this paper. And that's one of the big benefits of already having obtained your PhD, that you can simply pick up stuff and work on stuff that you like. but maybe coming up to that later. So on the left side, you actually see the market capitalization of Ohm, and you pretty much immediately recognize where this sell-off of $11 million came in. And you see this drastic change in market price, and there was a reaction, but it didn't fully recover. So there seemed to be a lasting effect. Yeah, sure.
Can you say a few words about the Olympus DAO? I think I heard in the past something. It's kind of was they manage a kind of a portfolio, right? It was like
yeah, I mean, for the purpose of the paper or for the purpose of this motivation, it's not too relevant, I'd say. But Olympus DAO is a so-called rebase token. So they issue new tokens if you allocate capital to their decentralized autonomous organization. And then the organization is actually using these funds and working with them, lending them out, generating interest, a yield, etc. So the whole DAO will grow and everyone will hopefully gain more value in the future. But in that specific case, that was, as I later learned, also one of the early backers of the project that simply said, the price has fallen so long, I simply do not want to see it falling more. I want to buy a house, I'm out. But still $11 million versus $400 million market capitalization is so off that there must be some structural problem in the DeFi market. So obviously this is only one single event, and I see that someone wrote in the chat. Oh, okay. Obviously that's only one single event, and I was interested if this there's some sort of effect that is structural in the DeFi market that can be observed. So the fact, and I mean I already summarized that, the fact that a single transaction with a value of below 1% of the implied value of this cryptocurrency token caused a market cascade of around negative 30% suggests that this market capitalization metric that everyone is using in crypto markets, be it on CoinMarketCap or CoinGecko and all these data sites, is not at all a meaningful metric to actually assess the value and the liquidity of cryptocurrencies. And there's some sort of inefficiency. And such large transactions like the Ohm one are no rarity in DeFi markets. So there are even DeFi Sniper, as an example that I picked up, projects that track such large swaps and report them via Twitter and Telegram close to real time. So you can pretty much immediately monitor this type of information, even if you don't program it yourself and don't check the blockchain yourself. So below here is an example of this DeFi Sniper bot on, I think I took it off Twitter a couple of days ago, where someone transferred $42 million worth of Shiba Inu between two addresses on Ethereum. And you can then immediately see that. And this may mean something. Maybe this person will sell these tokens. So should I potentially react? Who knows?
Can I ask a question?
Yes.
So how it's compared to traditional finance? In traditional finance, big transaction like that also get published?
No.
No.
Yeah, and that's the big difference. I mean, in DeFi and in cryptocurrency markets, you can immediately see if someone sends 3,000 Bitcoins to Coinbase, that means that most likely the Bitcoin price will tank. And I mean, now we're talking about a smaller phenomenon that is decentralized finance and DEX swaps, but that's interesting. And one other big example in cryptocurrency markets and this type of information is the issuance of stablecoins. That when, for quite a while, when Tether, for example, issued billions of dollars, that simply meant that new capital is entering the market. And that means, hey, a couple of $1 billion of buying pressure will most likely enter cryptocurrency exchanges in the next couple of days. So prices may rise, and that's what traders picked up, and that's why prices actually rose after that. And I mean, it fully makes sense. So if we have such exceptionally large cryptocurrency sales or purchases on decentralized exchanges, there are multiple reasons why there could or even should be an abnormal market reaction. So one that actually exceeds its actual economic impact, such as I showcased in the example of the sell-off. So if someone withdraws or adds tokens to a liquidity pool on, be it Uniswap or SushiSwap or something, that simply shifts the supply curve of the underlying liquidity of this token. And this makes future trading more or less efficient. So more efficient if the supply curve gets higher, and less efficient if it gets lower. And that means an increase in liquidity should actually represent a positive market signal for traders that are looking to purchase this token, and decrease in liquidity should represent a negative market signal for traders. And traders should or will update their expectations that they have of a specific price of that token, which should then result in direct buying, selling, or temporary absence from participating in the market at all, because they do not, or because they are not able to interpret the information that they are being presented. And I think not being able to interpret what is going on in DeFi markets is one very big topic. And especially if you are an arbitrageur or liquidity trader, that is something that is very, very relevant, because you do not want to trade against informed counterparties. So the research gap. So as of now, I found that there's no scientific research that addresses the question of how positive or negative price shocks on DEXs actually affect the prices of crypto assets. Well, there are lots of studies on other assets, such as stocks or oil shocks, etc. And therefore, my idea was that the study aims to investigate and quantify these effects. And the factor liquidity is obviously strikingly important to understand financial markets, and essential if you want to interact and behave somehow in this market. Coming back to the topic of arbitrageurs and liquidity traders especially, and especially if you trade tokens such as, be it whatever, if you trade tokens that are also tradable on centralized exchanges, and now you trade them in DeFi markets, you need to understand these two markets and that they differ very much. So on centralized exchanges, you can use order book data. You can pretty much always immediately sell and buy, while on a market like Uniswap, you rely on blocks, Ethereum blocks, or be it another blockchain, you still rely on blocks that may have shorter intervals. Then you also have the topic of MEV and private transactions and flashbots and all sorts of attacks. So it's simply very, very difficult to both utilize liquidity trading in centralized and decentralized exchanges. And my feeling is that there are not too many liquidity traders right now that are very efficiently doing it, because DeFi is simply so tricky, and well, DeFi also lost a lot of volume over the last year, so it may simply not be that relevant anymore. Coming to the next slide. One motivation that was dear to my heart is to actually include the topic of market capitalization in the analysis. So market capitalization is the market price of a token that is multiplied by the circulating token supply, and to then analyze how high the relative swaps and market reactions turn out to be. So market capitalization is pretty much a relative measure then in terms of the swap size. And if market capitalization represents a proper proxy for realizable value of crypto assets, then the relative impact of such a swap should also be at most as high as the relative market capitalization of it. So if 0.81% of Ohm are being sold on a DEX, then in the short run, the price should also, the market capitalization should also only decrease by 0.81%. Obviously, I suspect that that's not the case because of the Ohm example and many other examples, because DeFi coins are very illiquid and inefficient, and you don't really need to test that to know that. And it's rather reasonable that market capitalization puts the actual value of crypto assets much higher than it's realistically the case. So if we talk about a coin like Shiba Inu or so that has $50 billion of market capitalization, it's very, very unrealistic that these $50 billion really exist. But if we talk about Apple stocks, for example, I have no idea how much market capitalization Apple has, maybe 100 billion or so, but my feeling is that you could realize much, much, much more value of that in comparison to the Shiba Inu, which makes sense too. So if the price impact of a large swap is higher than it would rationally be, using market capitalization as a fair proxy, we can then interpret this as an indication that this assumption is correct. So data and methods. And we rely on trade-by-trade data, or rather swap-by-swap data from 3 major decentralized exchanges on Ethereum. These are Uniswap v2, Uniswap v3, and SushiSwap on Ethereum, which likely account over 95% of the DeFi market share at the time, only for the tokens under consideration. I mean, the DeFi market itself is much bigger. We use an explorative approach to identify tokens, and now, again, the beneficial status of already having obtained a PhD comes into play, because this is such an explorative approach is not the easiest way to do, and is not the easiest way to get by reviewers. So if I would review this paper, that's rather easy to criticize. I extract pretty much all large swaps that are published by this market intelligence board, DeFi Sniper, that I mentioned, between June 5th and January 23rd, 2022. And this results in about 30,000 swaps with an average size of a little over $1 million. And that relates to 511 unique crypto assets. And then I do some sort of data cleaning and exclude reference currencies such as US Ether or Wrapped Bitcoin, USDC, USDT, interest-bearing coins, staked coins, leverage tokens, etc., and conduct the sensitivity analysis based on the number of swaps and events, simply to have enough events per coin that I look at, and second, to have high enough trading volume and token value locked, TVL, for each of the coins that I look at. So these checks actually result in a sample of 14 tokens, that are then being used to collect data and conduct the analyses. So it's a very explorative approach, and it invites criticism, but hey, it's a fun project, and I was interested in a question that I came up on Twitter. So come at me, reviewers.
I think Danny has a question.
Yeah. I think you mentioned this briefly, but can you just explain again how DeFi Sniper picks people? I'm trying to just get a sense of what population we're looking at in like kind of just what I can take away from the sample.
Yeah, I think DeFi Sniper indexed Uniswap v2, Uniswap v3s, and SushiSwap and tracks all their pairs. So whenever they see large swaps, and my feeling is that they define large swaps as swaps over $1 million or something like that, they, I have to look that up actually, they then immediately broadcast this via Twitter and Telegram. And they have various other DEXs too, so Curve and stuff like that too, but I only focused on the three major ones.
But they have a sorting mechanism to, so if you have a sandwich attack, which you buy 1 million and sell 1 million, they count it twice or they ignore it?
No. They count it once.
I see. Okay.
Yeah. No, they are pretty good. That was at least my feeling. And after all, yeah, I did a lot of manual cleaning simply to come up with a number of tokens that were then suitable. But after all, I didn't use any of the DeFi Sniper data that I extracted for the actual analysis, but simply used the data to come up with a set of tokens that may be very interesting for such an analysis. So once I identified these tokens, then I gathered all data fresh. So coming to that, so there's a solution called Flipside Crypto, where you can actually generate custom APIs for Ethereum and various other blockchains. And for each token, we then generated APIs that provided us with all historic swaps that were made on these DEXs from May 20 to May 20, well, from May 2021 to May 2022. And that was also quite annoying because I think Flipside only allows the extraction of something like 100,000 data points per API. So we had to do, I think, 11 APIs alone for Shiba Inu because there was simply over 1 million swaps. So that was very annoying, but my feeling was it's still the best option. So after all, we had a sample of 2.7 million individual trades of these 14 tokens. And we enriched the data with the circulating supply of each token from the CoinGecko API to calculate the market capitalization. So you can see that the smallest token that we actually look at is the Ribbon with an average market cap of around $116 million. And the biggest one is Chainlink, or no, Shiba Inu with 10.9 billion. And as you can see, most of the tokens have one DEX where tokens are predominantly traded. For example, if we look at ALCX, then 89% of the traffic is on SushiSwap. Or if you look at ENS, Ethereum Name System, then most of the traffic is on Uniswap v3, etc. And as I said, I'm rather confident that these swaps listed here account for pretty much 95% of all DeFi swaps of these tokens over the time period on Ethereum. Okay, so what we did then was we followed a two-step approach. So first we investigate the link between the relative swap size and returns, and then we examine the extent to which very large and unexpected buys and sells actually trigger a market reaction. And for that, we needed to define time intervals based on swaps to test the effect of information propagation. And that is, again, a pretty subjective task, as it's pretty much always with event studies, because you simply have to define the periods that are of interest for you. So we defined 3 single trade windows that are T-1, so the swap before the event, T1, T0, the event itself, and T+1, the swap after, to actually look at short run effects. And then we defined various multi-swap windows to actually look at pre-swap activity and long run cumulative returns. We first calculate Spearman rank correlations to identify the general relationship between relative swap size and future returns for sells and buys. And then we followed this by an event study to calculate abnormal returns around large buys and sells. And we define large buys and sells as the 1% percentile in all of swaps. And again, this is sort of subjective. We actually did some robustness checks and did the same for the 2% and 0.5% percentile, and the results didn't change too much. That is actually not included in the working paper right now. But for the purpose of analysis, 1% seems rather solid.
So can I ask you,
Yeah.
so if I get T is mean the swap before and after the event.
Yes.
But swap can be in, like, if you, like, let's say if the information transfer fast, so I can imagine that it will be 3 sequential, the same blocks, but sometimes with pool with not a lot of traffic, it can be few hours before and few hours later.
Yes. Right.
So I like from the data, I guess that the majority of the time it's same blocks, right? It's almost the same time. Okay.
Yeah. Especially because MEV is quite a topic, as we will see later. And there's lots of transaction reordering around these swaps. So some descriptives. So this is simply one part of a table that is included in the paper, and I wanted to highlight 2 small findings. So first of all, here we see the number of swaps, and then the sell orders and buy orders. And sell orders are essentially swaps where you send a specific token into the pool, and buy orders are tokens where, if you look at Aave, where you send Ether or something into the pool and then receive Aave tokens. And as you can see, the average sell order for Aave is $26,800, and the average buy order is $27,100. So it's pretty even. But if we look at the standard deviations, they differ quite a lot. And this could actually indicate that smaller retail traders are mostly buying tokens on DEXs, and that larger professional investors or stakeholders use DEXs to sell their tokens in larger transactions. And I mean, that also makes quite a sense. And another observation on the bottom is that for ENS, Ethereum Name System, we can see that the sell orders are much, much smaller compared to the buy orders. And this is an indication of overselling in these decentralized markets, which we can also see in a negative return, obviously, over the time. And this can most likely simply be explained by the fact that ENS was an airdrop token. So multiple users on Ethereum simply got airdropped the token because they historically participated in the Ethereum name system. And then lots of people gained free money overnight and simply sold it. So it's not too crazy to see that result, but if you don't know this context, it might be confusing. And for other tokens that are not included here in this example, for example, the sandbox or something, the ratio turns. So we don't have an overselling, but we pretty much have an overbuying. And that could indicate that these tokens are up at that time on the analysis still true DeFi tokens that are actually more being bought on decentralized markets and not centralized markets. So we have quite a diverse set of tokens that we look at, and it will be interesting to see if there are similarities across all of them, because right now they differ quite a lot on the descriptives. So correlation results. That's not the most intuitive table. I mean, it's intuitive, but it's not easy or nice to read. So I put some coloring over it. These are the simple correlation results between relative swap size and future token returns. And as you can see, we pretty much have very consistent results. So all single swap windows in the seller orders are pretty much negative. All single swap windows on the buy orders are positive. All negative 15 swaps on the sell orders are positive. All negative 15 swaps on the buy orders are negative, etc. So here we actually have some uniform results, and that means the results of these two subsamples, buy orders and sell orders, are almost diametrically, well, opposed. That suggests that these effects cancel each other out. And with some few exemptions, we actually find significant negative correlations between relative size of sales and future token returns. And this result is also rather logical, so it's not too crazy. And the opposite holds for purchases where the relationship is almost exclusively positive. And yeah, this suggests that very large swaps from the tail of the distribution may actually have a particularly large impact on token returns. So that's why it makes sense to study this effect some more detailed by an event study, which I did. So here's an event study, and this is for all tokens together, based on the two samples of buy orders and sell orders. And here you see the mean cumulative abnormal returns attributable to large sells or large buys based on a transaction by transaction or swap by swap basis. And as we can see, for sell orders, we actually have a negative abnormal return before the actual swap. And that is, here I wrote it down, it's negative 0.11%. And this is an indication that the market is already picking up this information and is somehow incorporating it. And most likely due to MEV trading, arbitrage, sandwich attacks, or something like that. And if we look at buy orders, there's not too much happening before the swap. So it pretty much drifts around zero, and only one swap before the actual event, the cumulative abnormal return jumps to positive, and after that it's a rather linear positive drive. So we have very different effects for sells and buys. So that's quite interesting. And if we look at the numbers in perspective, when we have an average market capitalization of around 3 billion of these tokens, then a cumulative abnormal return of negative 0.11 in the swaps before the actual event already means a loss of $3.3 million, which is actually 4.4 times more than the economic value of the average sell order. So we see that discrepancy that we suspected before. And this value drops further in the subsequent swaps to negative 0.18, which is a factor of 7.37 before it actually recovers. And if we look at buy orders, then we already see an abnormal increase in value of 0.266 million, which corresponds to about 32% of the event volume. And subsequently, so after the swap, the market capitalization increases by another 3.6 million on average, which corresponds to a factor of 4.39. So we have a factor of 7.37 for sales and a factor of 4.39 for buys, which means something's off with market cap. Surprise. So if we look at individual coins in the event studies, then for sell orders, the average swap per asset is around between 120,000 and $1.1 million in absolute terms, and between 0.003 and 1.18% in relation to market capitalization. And well, we also did that for buy orders. No need to read that. But if we look at sales swaps, then we actually see the results that traders have moved ahead of the transaction as part of mempool monitoring and as part of MEV, sandwich attacks or front running or something like that. And at the time of the swap, abnormal returns on sells actually range from negative 0.002 to negative 0.699%. And this is still up to negative 0.001% and to negative 0.56% in T+1. And one critical observation is that the relationship between relative size of the swap and market reaction, or rather the anticipation of an event in the previous swap. So for 8 of the 14 crypto assets, the abnormal and statistically significant return is so strong and negative that it actually exceeds the economic value of the swap. And if we look at the Aave as an example, so the top 1% of Aave swaps amount to 0.017% of the asset's market capitalization, but the significant abnormal return already equals 0.015% in the swap before the actual event. And this is similar for various other tokens. And at the time of the event, this phenomenon is actually amplified with 10 of the 14 projects, so 71%, having a significantly higher economic market reaction than we previously assumed. And for the coins MakerDAO and Shiba Inu, the results are the largest. So abnormal returns are actually 18.8 or 17.6 times as large in comparison to the swap size. And across all tokens, this factor is 4.32. So for every single dollar that you sell in such a swap, the market capitalization of the tokens declines by $4.32. Let me check the time. Okay. If we look at buys, we actually have a very similar effect, but with a reverse sign. And for 64% of the token, the return effect exceeds the relative size of the swap. And if we look at the 3 single time points again, so negative t-1 to t+1, again, 71% of the tokens exceed the relative size of the swap. And for some of the tokens, the differences are very large. For example, Aave, Compound, Mana, or Shiba Inu. Again, Shiba Inu with a factor of 17. And that means that an average swap in the 1% percentile of Shiba Inu amounts to around $157,000. And this raises the market cap of the crypto asset on average by $2.6 million. So quite a good market if you want to manipulate. The average factor across all tokens for these 3 swap dates is pretty much 7. So for every dollar invested into a token, its market cap grows by $7. And as with sell orders, this simply shows that market cap fully reflects the views and valuation of the market. So coming to some conclusion, we can pretty much say that extremely large unanticipated swaps result in significant overreaction in DeFi markets or in decentralized exchanges. And I already mentioned this. On average, we have some very high factors for sells and buys in relation to market cap. This suggests that crypto assets are very overvalued and that market cap is only of limited value for valuing these possibly illiquid assets. And we also find that the market actually reacts before the actual events. So we have MEV, front-running attacks, etc. This isn't really illegal, but it's likely a problem for individual investors that actually participate in this market, and they will be scared away. So every person that finds out that they were sandwich attacked, and they pretty much, they will lose faith in participating in these markets. So final conclusion and major conclusion, market cap is very unsuitable for determining the true value of crypto assets. And the main reason for this is that the metric completely disregards liquidity. So DeFi is a great example to showcase that. And one example can be, so unlike for stocks, which are highly regulated, I can easily create a Ethereum-based token and also a Uniswap trading pair in a couple of minutes at pretty much no cost. Well, a little cost. And I can simply generate 1 million tokens and then trade one of these tokens in this trading pair on Uniswap and drive its price up to $1,000. And now all my tokens have a market cap of $1 billion. And now I only need to find some retail investors or some data site like CoinGecko or CoinMarketCap that list my token, and then all the retailers will start to buy it and I can profit. And that's quite a huge problem in cryptocurrency markets, and it would be very, very beneficial if the market could come up with some valuation metric that actually incorporates liquidity and potentially also historic liquidity and trust, but easier said than done. Okay, I think that's it.